Wow, okay, so today the Bank of Canada released its financial stability report, and they were way more honest than I've ever seen them be before. And they outlined their top 3 risks that could be disastrous for Canadians if they are to come true. And these risks would impact every single Canadian when it comes to their banks, comes to their housing or mortgage costs, as well as their jobs. And even at the end of the press conference, the Bank of Canada dropped a total bombshell that could change everything when it comes to the way that we think about our investments going forward. So let's get into exactly what was said today, and we'll break things down more clearly after every clip so that we can get clear in plain language about why the Bank of Canada is so worried. Now, to be clear, this is not a forecast, something that the Bank of Canada says will happen. It's simply a list of things that the Bank of Canada is concerned about and is monitoring actively. And the first of the 3 that we're going to cover today is something that relates to Canada's big banks and their ability to give Canadians loans, which could have a big impact on a bunch of things. Let me get my face out of here and I can show you this clip.
The first is Canadian bank funding. Banks channel money from savers and investors to borrowers. As interest rates go up, banks need to pay savers and investors more, so the funding they use to make loans becomes more expensive. And Canadian banks generally have more demand for loans than can be funded solely by Canadian deposits and investments, so they rely on attracting additional funding from global wholesale markets. These markets can be significantly affected by global events such as recent banking stress. The recent turbulence in global markets stemming from bank failures had little direct impact on Canadian banks. But if global stresses were to return and persist, bank funding costs could rise beyond the higher levels intended by tighter monetary policy.
So what the Deputy Governor of the Bank of Canada, Carolyn Rogers, is saying here is that because we're in this period where there's high interest rates, well, banks are having to pay customers higher interest rates on their deposits, on their savings accounts, things like this. So as a result, it's more expensive for them to give loans to Canadians as well because the cost of them acquiring the capital that they then go loan out is increased compared to what it was before. Now, as a result of this increasing in the cost of them borrowing and lending capital, they're more likely to go to global markets to source this capital. And she's saying that, okay, if we see more bank runs and bank failures and more failures within the financial system, well, it could have an impact on Canadian banks' ability to give Canadians loans. Now you might be thinking, Russell, I don't need a loan, so how's this going to impact me? I'm not planning on getting a house. I don't need a mortgage. How's this going to impact me? Well, when it comes to loans and how those loans and the ability to get a loan impacts the entire Canadian economy, it's far more impactful than you might think. It's sort of very interconnected, right? If we have a challenge to get a loan, this actually also applies to businesses, right? If it's harder for a business to get a business loan to expand their operations, then that also can translate into fewer jobs for Canadians as less businesses expand because it becomes more expensive or more difficult to source the capital or to borrow money in order to do those expansions. Now, as a result, it could be harder for Canadians to get a job and harder for Canadian-based businesses to actually perform well.
In addition, in a severe stress situation, funding could also become harder to secure. In response, banks could likely constrain credit to households and businesses, potentially exacerbating an economic downturn.
So she's saying on top of these sort of global issues that could make it harder for Canadian banks to give Canadians loans, she also says that if shit really hits the fan and stocks go down in value and real estate goes down in value, well, it could be even harder for banks to give you a loan because oftentimes you need collateral to get a loan. And if the thing that you're using as collateral, either a home or a stock portfolio, goes down in value, well, those banks will be less likely to give you those types of loans because you have less valuable collateral. Now, all these things put together could make it a lot harder for Canadians to get loans, Canadian businesses to get loans, the Canadian individuals wanting mortgages. It could make it harder for them to get loans. And as we already discussed, this has a sort of ripple effect on the rest of the economy, expanding out into jobs in other areas. Now, moving on, the second risk that they're monitoring relates to what recently happened in both Switzerland and the US, which is a modern day bank run. Now, listen to this clip, then I'll explain the unique situation that's actually allowing these types of events to happen.
The second area we're monitoring closely is the interaction between global stresses and liquidity in fixed income markets, both globally and in Canada. In an environment of greater pressure on bank funding, major banks may have less capacity to supply liquidity to market participants in periods of stress, which is when they need it most. This market liquidity is crucial to financial stability, given the growing importance of asset managers and other non-bank financial intermediaries that rely on it. The extreme market stresses at the outset of the pandemic showed that the financial system is vulnerable to sudden spikes in demand for market liquidity.
Now, in order to explain all of this, she uses a lot of sort of complex and very financial focused language that makes it hard to see what she's actually saying here, but it's actually way more simple than she makes it sound. She talks a lot about liquidity, and the ability of banks to supply that liquidity, or ability not to supply that liquidity, given their fixed income bond holdings. Now, here's exactly what that means without all of that jargon. These bank runs that we're seeing happen in other countries are a result of those banks not being able to give deposits back to their deposit holders. The people who hold money at the banks are like, we actually don't have the money to give you if you all come ask us for money at the same time. And the reason that they don't have this money or this liquidity to give back to their banking customers is because, well, when they get the money, those deposits in the first place, they don't just hold it in cash at the bank, and they do a bunch of different things with it. One of those things being holding fixed income assets, things like Government of Canada bonds, right? Or in other countries, other government bonds. This is largely seen as like a very low risk investment because you can buy a bond and then get repaid the amount that you paid for that bond plus a premium once you hold that bond to the end of its term or the end of its lifetime. The only problem is, in the meantime, while you're holding that bond to its maturity, well, the value of it can fluctuate up and down. And as interest rates increase, which is something the Bank of Canada has sort of done here, raised interest rates extremely rapidly, well, typically bond values go down in high interest rate environments. So if everybody comes knocking and says, hey, where's my money? And the value of that money has held in bonds has gone down drastically if you were to sell it immediately, well, then obviously you have a problem. Now, in the States, they solved this by saying, okay, well, we'll actually buy all these bonds back from you at the value that you would have gotten at maturity so that you're going to actually have the ability to pay back your deposit holders. But Canada hasn't done anything like that because we haven't needed to, obviously. But that's the sort of money printing type solution that the Federal Reserve in the States employed. But obviously, this is something that the Bank of Canada is monitoring very closely. Now, the third worry is that the Bank of Canada is finally admitting that they're concerned about Canadians being able to service their debts given the higher interest rates in this environment, right? They've constantly said, hey, Canadians, they're going to be good for their mortgages. They're going to continue to pay them because they historically have done that, even in high stress environments. But now the Bank of Canada isn't so sure that that trend is going to continue. Listen in on this.
The third area the bank is watching closely is the ability of Canadian households to service their debt under higher interest rates. Higher debt servicing costs are stretching budgets and reducing borrowers' financial flexibility. About 1/3 of households have seen their mortgage payments increase since February 2022, just before the bank started raising the policy interest rate. More households will see their payments go up in the next few years as they renew their mortgages. Lenders and regulators are taking steps to provide borrowers with options for managing higher payments, such as extending amortizations. However, as borrowers make use of these options, they may have less capacity to absorb future shocks.
So for the largest debt that most Canadians have, which is their mortgage, well, the Bank of Canada is saying, okay, we've seen the cost of paying interest on those debts actually increase significantly, with 1/3 of all Canadians who hold mortgages seeing that mortgage increase in its interest rate since February 2022. And they're only expecting this number to increase over the long term. Most of these impacts on mortgages has been on variable rate mortgages, ones where the interest rate can sort of change over time, right? But soon enough, we're going to see this impact hit everyone who has a fixed rate mortgage, right? A fixed payment mortgage, a fixed rate mortgage, where they only have to change their interest rate at the end of their term, which is usually around 5 years. Now, soon enough, we're going to see these higher interest rates hit a larger amount of mortgages that exist in Canada because those fixed rates are going to have to renew eventually. And we covered it on the channel before, but banks and financial institutions are using all kinds of wacky kinds of tools and workarounds to help Canadians continue to be able to pay their mortgages even if they wouldn't otherwise be able to afford it. One that we've talked about a lot on the channel is that banks are actively extending amortizations on mortgage loans. Amortization is essentially the amount of time that you have to pay the total loan off in, right? So if you have a 20-year amortization, that means if you were to pay your monthly payments for 20 years, you would have paid off the entire value of the loan that you took out to get your property, right? Now, if you extend that amortization longer, 30 years, 40 years, well, all of a sudden your monthly payment goes down drastically because you have a longer amount of time to pay off the value of your mortgage. Now, you end up paying a higher interest rate, but in the short term, your cash flow problems could be solved because your the monthly payment goes down. And the Bank of Canada is essentially saying, like, yeah, that's kind of a good pressure release valve for these people so that they don't default on their loans. But the fact that we're releasing that pressure means that we can't then again unscrew that cap and release all that pressure again because we've already extended amortizations. So if we do this once and then we continue to have this problem, well, we've already extended amortizations out as far as we could. So what's the answer now? They say it's not a long-term solution, but it is helping in the short term.
Canadians have a long history of paying their debts, even under stressed conditions, and so far households are proving resilient despite the sharp increase in interest rates. However, in a severe and prolonged recession, mortgage defaults could rise, leading to credit losses for lenders. That, in turn, could lead to a further pullback in credit, worsening a downturn.
Here she's talking about the potential risk for a negative spiral in this kind of situation. If we have a really long recession, well, then we could actually see an instance where Canadians can't extend their amortizations any further and they actually stop being able to pay their debts. And we could see the amount of mortgage defaults rise. Now, if we were to see that happen, well, of course, the banks wouldn't like that, right? Because that means losses on their loans, right? If people default, then they're not getting their money that they're owed. Maybe they have to take a loss when they do a foreclosure or a power of sale and sort of sell that property. They're probably losing money, both due to the time that it takes to do something like that and the lower real estate values than the loan that they actually gave out. If we see that happen, banks aren't going to like that, and they're going to say, maybe we should think twice before we give out more loans if we're in this environment where Canadians just are simply defaulting and not paying us back. We're going to sort of double check you, triple check you, make it extra hard to get a loan because we are scared of losing money on our end. And we've already talked about the ramifications downstream that this can have on the Canadian economy if credit dries up, if people aren't able to take on loans. Now, they haven't given us some sort of scale of 1 to 10 on how likely all of these risks are to happen, but the Bank of Canada is most worried about all of them happening at the same time. That would be a worst case scenario if it were to happen. However, the bank says, hey, we have an ace in our pocket. We have a solution. Even if all of these things were to happen, which would be an absolute nightmare scenario, we have a solution. And if you followed the channel for a while, you might know what the Bank of Canada's secret magic trick is whenever there is a lack of financial sort of stability in the markets. Listen to this clip and we'll get into it.
The vulnerabilities that we describe in the FSR may not, on their own, threaten financial stability, but shocks tend to have more impact when vulnerabilities have built up. At the Bank of Canada, we will continue to monitor the financial system closely for signs of stress, and we have the tools needed to provide emergency liquidity if severe stresses develop. In fact, we've recently reviewed our pandemic-related liquidity interventions to help us better target our response in the future. We stand ready to act, if needed, to safeguard the stability of the Canadian financial system.
Wow, that is a big deal. And again, they use this complex language to sort of masquerade what they're actually saying here. But this is going to have a big impact if it's a step that the Bank of Canada has to take. They're essentially saying, again, if shit hits the fan and things get really bad, we will step in as the lender of last resort. We will provide liquidity to the system. We will start printing money again. That's essentially what they're saying here, is that if this system stops functioning as it should, we will go back to similar things that we did at the beginning of the pandemic when that was a big disaster and we were worried about the financial system. What was the answer? We turned on the money printer through a strategy called quantitative easing. Essentially, the Bank of Canada, to oversimplify it, allowing more money to enter the system, an increase in our M1, the sort of measure of all of the dollars in the system. Again, I'm oversimplifying here, but this is quantitative easing, money printing as a solution to this lack of liquidity in the system, or the unwillingness of the big banks to give loans to people. The Bank of Canada says, we will step in and we will be the person that allows for these loans to actually happen. But if you think back to what happened when quantitative easing was the solution at the beginning of COVID, you'll know that there are some good things and some bad things about this, some very bad things. On the good side of things, it says, okay, well, we're going to make sure that the economy continues to function. Maybe there won't be as deep long-term scarring in the economy as a result of this liquidity drying up, because the Bank of Canada is going to be the liquidity provider, right? These are positives. These are certainly positives. The fact that the financial system keeps its wheels turning to live on yet another day. But then we have to talk about the bad side of things, right? When you have quantitative easing, what we saw, certainly looking at the pandemic, was a widening of the wealth gap, largely because the first thing that happens when we have an addition of money into the system, when there's money printing, we see asset price inflation first, right? These are things like stocks and real estate. We saw an absolute real estate boom as a result of low interest rates and huge amounts of liquidity entered into the system by the Bank of Canada's quantitative easing or mass bond purchasing program that they started at the beginning of the pandemic. Saw the same thing in the States and in Canada when it comes to stocks, a total boom after the Federal Reserve did the same thing as the Bank of Canada and provided this sort of economic stimulus to the markets. And that might sound like a good thing for people that own assets, own real estate, own stocks, own these hard assets, maybe even cryptocurrency, right? Or gold. This might sound like a good thing, right? Because these are these types of assets that will hold their value if we're in this situation where the money supply is being increased over time, right? But it's not a good thing for the people who don't have the means to own assets, right? Because all of a sudden, the thing that comes after asset price inflation is, well, inflation, normal CPI inflation. We start to see that in the reports. The cost of living goes up and the value of your dollar goes down in this type of situation. So we better all be crossing our fingers that all three of these risks that the Bank of Canada has discussed don't happen at the same time, forcing their hand to actually provide this stimulus via quantitative easing. Because while it might make asset prices go up, it might make you feel good when you look at your investments. For a lot of people, this will be a very negative thing as the cost of living rises and as the gap between the haves and the have-nots increases, the people who have assets and the people who don't have the means to invest, don't have the means to save because of not being able to make enough money given the economic situation. This is one of the largest issues, I think, worldwide, is this sort of widening of the wealth gap. And I don't have a solution for it, but this is certainly how the Bank of Canada's actions and their risks and the things that they're worried about could impact this worldwide situation. Whew, man, I feel like I just went on quite the rant there, but I'm curious what you think about this. Let me know down in the comments below. If you're somebody that's worried about holding your money at the bank, I've got to remind you of something called CDIC. That's the deposit insurance, right? So if you're holding in any given account less than $100,000, well, the government and Bank of Canada and this sort of insurance corporation, CDIC, will guarantee that your money will be given back to you, even if a bank is to fail in a worst case scenario. So make sure that you're holding under $100,000 in each of your accounts to make sure that you can sort of get the full value of this CDIC insurance. Also, in some recent legislation that the government of Canada has been passing through, gives the Minister of Finance the ability to increase those CDIC deposit insurance limits. So we might even see that increase up to maybe $200,000, $250,000 to be more in line with what the FDIC in the States offers. But that's it for me. Subscribe to the channel if you haven't already done so and like this Canadian-focused financial content. I hope this video has helped you out at least a little bit, and I'll see you next time.